You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music can mean only one thing. It is Thursday. It is 1:30 p.m. Central, 2:30 p.m. Eastern. Yes, it is time once again for TWIFO, This Week in Futures Options, a program where we break it all down here. What's cooking on the futures options side of the fence? Maybe some ags, maybe some energy, maybe some FX, maybe some equities. You never know what's going to make it into the delicious stew that is TWIFO. That's why you got to tune in every week. My name is Mark Longo from theoptionsinsider.com, from this fun network as well, upon which you're listening to this program. If you're listening to the full network, you're missing out. Multiple shows a day, hitting you pretty much every day out there. So wherever you're listening to this, to TWIFO, wherever you're subscribed or downloading or streaming it from, make sure you upgrade to the full network. And of course, if you like what you hear, leave a review so other folks can continue to discover this fun program in these troubled times. It's more important than ever out there. And of course, keep those questions coming. We do love to hear from you guys. Let's see what we're hearing from on the show today. First, going out to the FTSE Russell hot seat, where we are joined once again by our old friend, Mr. Sean Smith, the Managing Director of Derivatives Licensing over there at FTSE Russell. Mr. Smith, welcome back to the program, sir.
Mark, it's great to be here. Thanks for having me again, and I'm looking forward to having an exciting show.
I'm looking forward to it, too, because joining us in the CME hot seat this week is an old friend of the program, even though he's only been on once, and he hasn't been on in a little bit. He is Mr. John Brady, the Managing Director of Global Institutional Sales over there at RJO. Mr. Brady, welcome back to the program to you as well.
Thanks much, Mark. And Sean, it's nice to be here with you guys. Thanks very much.
And John, as we like to kick off the show here, looking at the upside and the downside, a.k.a. the light side and the dark side, the big movers and shakers of the week. So where should we begin our journey, John? Should we begin to the upside, or I should say to the light side, or to the dark side, John?
I don't know. I think let's take a stab at the light side.
Oh, Sean, I can see why you like this guy. He's of a similar ilk, similar bent, similar mind to you, sir. All right, we'll kick things off to the light side. Remember, you guys, as always, can generate these reports for yourself. How do you do that? CMEGroup.com/TWIFO or indeed /TWIO, This Week in Options, an old name of the show. Both of those should work. Either way, you should be able to generate these reports this weekend. All sorts of fun stuff over there. CMEGroup.com/TWIO or /TWIFO is the place to go. You can do that while you're listening to this show. It works along. You can play along with us here on the home game here. Let's kick it off to the light side. Number 5 to the light side this week. This is another week kind of almost symmetrical, almost evenly split between light side and dark side, which is kind of interesting. We've seen that a little bit of late. For a while there in this crazy maelstrom of a market where we find ourselves, it's usually all green or it's all red. This week, kind of evenly split, which is kind of interesting. Number 5, corn, 3.86% to the upside. Number 4, Casey wheat, up 4.07%. Number 3, lean hogs, getting all ag heavy here in the top 5 today. Lean hogs up 5.64%. Number 2, nat gas. It was number 1 to the light side last week. This week it is a paltry, a meager number 2, 5.68%. That means number 1, lumber. Lumber back in the rampage here, up almost 11%, 10.75%. It was number 2 weeks ago. And it was number 5 on our list the week before that. Now it's number 1. Back up to number 1 here on the upside. Let's go to the dark side. We're going to go beyond the top 5 to add a top 6 because a lot of you keep asking us, what about crypto? What about crypto? Where does it fall? Well, this week it falls just outside the top 5 to the dark side. I should say really the bottom 5. It's number 6, off 3.7%. Then number 5, oats. One of the few ags on the dark side here, off nearly 4%, 3.95%. Was number 5 last week as well. So 2 weeks in a row off on the number 5 on our dark side. Last week was only off 1.93%. This week, pretty much doubling that up to off 3.95%. Number 4, RBOB, off 4.33% or so. Number 3, gold, taking a bit of a break after just being on the rampage all the way up here, off 5.33% this week. Number 2, silver, another name we've been talking about a lot of late, off nearly 5.5%. Was number 2 to the upside last week, up, get this, 20.64%. So giving a little bit of that back, but still up 20, almost 21%, down 5.33%. I think most silver bulls would take that trade. Number 1 to the dark side this week, Eurodollars, off 16.25%. So crazy week for Eurodollars as well. John, this is an interesting week because it's kind of very evenly split between upside and dark side. So there's a lot to unpack, a lot to analyze. Where should we begin our journey this week, John? Which product category, which complex is really resonating with you and the folks at RJO this week?
Well, I think there are two, and I think when you look at the dark side, Mark, and you see number 2 silver, number 3 gold, I think that's really kind of a more encompassing macro trade as it relates specifically to the U.S. dollar, which ties into Fed policy, physical policy. You know, here right now, as we make this recording, you know, equities have kind of a nice little upside trade to them today as EMA, S&P futures, the subcontracts are going to kind of approach its contract highs, whatever else. And now we're seeing a reversal, and we're seeing this reversal, of course, on further chatter by both sides of the political aisle's leadership that any sort of COVID-related extension of weekly jobless claims benefits is still a few days away, and this thing could stretch into September. And so what you're seeing, you know, stocks kind of come off a little bit. But going back to this whole silver and gold concept, it's really a dollar trade. And what, you know, Federal Reserve policymakers have in store, what physical policymakers have in store, specifically as regards the size and scale of U.S. debt issuance into 2021, 2022. And really kind of what the supply of global dollars will be within the international monetary system coming forward. So to your point, on the dark side here, silver and gold both gave a little bit back last week, without question. But longer term, both the medium and longer term, there's probably more upside here, as we think here at RJ O'Brien that part of the solution here by both monetary and fiscal policymakers is for a lower dollar. And so technically, at the end of last week, we had seen, the euro currency technically overbought, gold and silver technically overbought. We look at things like MACDs and Bollinger Bands and relative strength indicators, 14-day, 9-day type stuff, and they were all overbought. So the correction that we've seen since has been sort of healthy. It's been sort of a little bit of a digestive trade. It's been, a little bit of a kind of a burp trade, so to say. Just kind of had to retrace and pause a little bit. But I would suggest to your listeners and to your wide audience that I think in time, we're going to see kind of more of gold and silver maybe being on the light side, as again the dollar point has more downside than upside here on a medium and longer term basis.
That's a good point. We've been touching on the dollar a lot of late on the show, but you're right. It touches on so many of the complexes that have been lighting it up for these days. Equities, of course, rates, of course, metals, clearly FX. So many of the complexes that have been lighting up our tape have been driven by what's going on out there in the dollar. Speaking of driving volume and driving flow, I'm curious, John, it's been a few months since you've joined us here on the program. Obviously, the markets have not been quiet since then. It's been pretty tumultuous. What has been dominating the tape? What's been the big area of focus for RJO's customers out there since the last time we chatted? Has it been predominantly equities? Has it been rates? Has it been ags, metals? What have they been trading up in mass since we chatted here, John?
Yeah, no, it's been mostly a dollar trade and a risk trade. So I think that the equity market bounced from really kind of a late March. Mark has really caught a lot of investors kind of offsides. And I would suggest to you that I think there's still a healthy amount of skepticism out there, given how NASDAQ and E-minis and even the Russell trades. There does seem to be kind of expanding breadth within this equity market rally. If you look at the technicals with the Russell 2000 performed quite strongly over the course of the last week or so. And there has been this rotation trade out of some of these larger cap NASDAQ names and leaders in the S&P 500 kind of out to kind of more broader names and more kind of small and mid-cap names. It's very, very healthy. But that's really sort of been the trade. The trade has been dollar. It's been the U.S. dollar, the performance of the dollar. The dollar index late last week traded to a new 3.5-year low. Got a little bit of a bounce early part of this week and it kind of rolled over a little bit today on the trade. But it's really the dollar and risk have really sort of been the two drivers of trade, the dollar and of course stock valuations. Those have been the drivers of trade, and those trades have been driven by really sort of two things. A, development within this whole COVID-19 pandemic. There seems to be a little bit of a flatlining and a rolling over in terms of new infections and death rates. Thankfully, we hope that continues. And then also to the stagnation of policymakers in Washington D.C. and their inability to come to some type of agreement in terms of the extension of these jobless benefits. And so those have really been the two drivers of trade, with the dollar reacting mostly negatively, but equities sort of tend to like this whole idea of divided government. It's only when government really is dominated by just one party, clearly, that equity markets get a little bit nervous. But this gridlock in Washington is kind of weighing on the market a little bit, but equities continue to sort of climb this wall of worry with, I think, an optimism towards a vaccine being found for this COVID-19 pandemic and maybe a continuing lightening up of the bad news on COVID hitting the tapes.
Yeah, it's hard to argue that the market isn't looking past all this COVID stuff. In fact, I've said it many times, this market has been whistling past the graveyard for some time. I'm kind of with you, John, in that it seems like a lot of the broad investing public did maybe miss out on a lot of this rally, because it's hard to argue that things weren't crazy and tumultuous back in March. Who would really sanely dive in with both feet at those levels? Maybe you dribble in a little bit, but certainly you don't dive in with both feet. Yet, obviously, large players were certainly buying this up, and we have seen a lot of people. You're like one of another number of guests we've had over the last couple of weeks, maybe alluding to the fact that a lot of the broad public has been on the sidelines for a lot of this rally, and certainly seems like anecdotally that might indeed be the case. Speaking of that rally maybe taking a bit of a turn for the worse here today, listeners. Of course, after coming on the heels of the big rally out there in most of the equities yesterday, really just pushing new all-time highs or threatening to set new all-time highs across most of the major indices. The market's taking a bit of a break here today, at least on the equity front. Coming into a TWIFO here, we did see a little bit more mixed going on in option block not too long ago, and the NASDAQ was firmly in the rally host seat. This time, most of them taking a bit of a break. NASDAQ threatening to give up those gains, only up about 0.25% right now. S&P off about 1/3%. Dow off about 0.5%, leading the charts to the dark side. And the The Russell 2000, actually a bit of a laggard to the dark side, which I guess if you're bullish isn't the worst thing. It's only off about 0.2%. So since we're talking all things small cap, before we get to that really quickly, let's break down the vol landscape and how things have shaked up since our last show. Coming into showtime, we saw RVX up to about a 30 1/3, which puts it up about exactly a third of a point from last show. It was about exactly a 30 last show. VIX is flirting around a 22 right now, which is pretty much unched from last week. So interesting things there as well. And then, of course, got our old friend VVIX, which is the volatility of volatility, at about 113.5. It puts it up about 7.5 handles. So we have seen some volatility of volatility since our last show. So that spread has widened out a little bit. It's about 8.6 between VIX and RVX, which puts it about 1.3 points wider than it was last week, which, interestingly enough, is exactly as much wider as it was in the week before. So 1.3 points wider last week, and then 1.3 points wider again this week. Interesting how things seem to be moving in lockstep out there. So a lot to unpack. Sean, I know you're watching all things Russell 2000 these days. What's been lighting up your tape since the last time we chatted, and what are you watching out here in Russell 2000 land this week, sir?
It's interesting times, and John made some really good points about the market and how resilient equities have been during this time where there's so much nervousness and panic going in the spike in COVID. But he's right about the equities might enjoy the political divide. If they can't get things done, they can't raise taxes either, right? So maybe there's some positivity there. And of course, Russell 2000 is a domestic index, pretty much. So in the last month, it has seriously outperformed your other big benchmark indices. I think over the past month, Russell 2000 has gained, somewhere in the area of 11% versus S&P and NASDAQ, which are up 5% and 2% respectively. There's been some pretty good articles out in the news this past week. A news editor named Brian Sozzi wrote a nice article, Once Quiet Stock Index Suddenly Zooming, and he's talking about the Russell 2000. And then there was an article in Barron's that came out earlier this week as well. Small caps are playing catch-up. Strong earnings revisions are a tailwind. So there's these momentum people are noticing, and the Russell 2000 is in small caps are performing well. And I think I say this almost every show. They outperform to the downside, and they truly are sometimes and most likely catch up and outperform to the upside when the U.S. economy shows some strength. So it's interesting times, and it's really interesting that spread between VIX and RVX is maintaining its composure, but it ebbs and flows, as we know. So really interesting to see that we're sticking at this 8.5, 8.6 range right now, because it has spiked, as you know, and it's come in dramatically, as we know. So interesting times ahead.
I'll say, what kind of editor calls the Russell 2000 a once sleepy index? It hasn't been sleepy for a long time. Has he been watching it for the better part of 2020? It's been blowing the doors off every other index.
He called it Once Quiet Index, Suddenly Zooming. Interesting title, interesting comment. But I actually sent you the article. I sent you the article, so you can blast it out to your listeners if they're interested in seeing it. So it's in your inbox somewhere.
There are many adjectives I would use to describe the Russell 2000 over the past 6 months. I'm not sure if sleepy even comes remotely to mind. Even on relatively quiet weeks, the small caps have been moving quite a bit, which is kind of interesting. Let's look really quickly, see what's lighting it up out here in small cap land over there at CME. Remember, you can look at this report for yourself. CMEgroup.com/TWIFO or /TWIO is the place to go. 1581 is where we find ourselves out there in small cap land right now. It's up about 15 handles. Just from this week, since Monday, of course, that's where our This Week In reports tend to center. Looks like most of the action is out here in September, about 22% of the paper with the big trade. Actually, the big trade, though, was the 1760 calls out here in the week threes in August. So that's kind of interesting. Pretty far upside. That's not usually what we see. Actually, I take that back again. No, it was actually the big print was the 1370 puts out here in September. That sounds more like what we're usually seeing out here. A little bit longer term and a little bit farther out of the money puts a roughly 200 handle out of the money puts. That makes more sense given what we see usually in small caps. John, I'm curious. I'm sure equities have been lighting up your tape over there at RJO. What are some of the big products everyone's slinging? Is it mostly the E-mini S&P, or what are folks slinging day-to-day in the equity front over there at RJO, sir?
Yeah, no, we've seen kind of two trades. First of all, there continues to be sort of this belief on buying on weakness. So weakness tends to be sort of short-lived within the equity markets, and it's the E-mini contract that a lot of our institutional investors like to participate in. Likewise, too, another large theme here, Mark, over the last couple of weeks has been the rolling up of calls. So accounts, larger institutions that wanted to kind of have exposure to the equity markets over the late spring and summer, given the carnage, rather than kind of buying outright contracts, they found themselves sort of maybe buying calls with the idea that from a risk reward basis, if they're wrong, so they give up the premium, but if they're right, they can kind of participate in the rally. Well, this time round, they've been right, and so one of the main themes we've seen here the last 2 weeks is the rolling higher of calls. So kind of rolling up to the and they tend to do it within like kind of 100 point bands. So 3,100 calls up to the 3,200 calls a couple weeks ago, 3,200 calls up to the 3,300 calls this week, and we anticipate that as late August turns into early September, there's a lot of interest in maybe kind of targeting the 3,400, maybe even the 3,500 strike in the SEPI mini. So that's really sort of been the trade. It's been a rolling up of long calls and a buying a dip of outright futures.
Interesting. Rolling up. So maybe the bullish party hasn't abated out there, despite the fact that big names like Soros and others are rattling their sabers saying, I'm out, I'm done, this bubble is too much for me. Sounds like RJO clients, not the case there, John. They're rolling up their calls, so they're staying in the party, at least for the foreseeable future of here. Speaking of the equity party and the volatility party, before we roll off equities, got to touch on this big announcement out there in the equity volatility landscape pretty much today. CME and NASDAQ kicking off a joint volatility product, the NASDAQ 100 Volatility Index. If you've been listening to this network for any length of time, listeners, you know this is kind of the most recent iteration of a product we've talked about for a while. This is Scott Nation's formerly Valdex and SKUDEX product. He initially planned to launch this with the ISE, the International Securities Exchange, many years ago, at least 5 years ago. It's probably the first I heard of this. It has since gone through multiple iterations. Of course, ISE was since acquired by NASDAQ, so ISE is not part of the NASDAQ exchange family, so they owned this license. If you're not familiar with what this is, very succinctly, listeners, it's effectively VIX without the SKU, which, if you know anything about VIX lately, the SKU's been causing a lot of the problems. A lot of the lawsuits that have centered around VIX with the SIBO of late are around with the impact that SKU has on the overall calculation. The Valdex and SKUDEX, as they were formerly known, now NASDAQ 100 Volatility Index, VolQ, now under their rebranding, they don't have that SKU issue. So maybe that makes it more attractive. I know the folks at NASDAQ have been working hard for the last couple of years to make this come to fruition, and now they're launching it as a joint venture with CME. I think this is kind of an interesting one. We're going to have Tim McCourt on the show in a couple of weeks to talk about this, I believe. Probably maybe we'll get Scott Nations or some folks from NASDAQ on as well to talk about why they felt the need to do this joint partnership. But if you're out there looking for more products, more potential opportunities to play in the equity volatility space, it's hard to argue that NASDAQ isn't worthy of looking at, because that index has been moving quite volatile of late as well. So maybe interesting things afoot here in the equity volatility space going forward. Sean, did this one come across your radar, and does it intrigue and or surprise you, this joint CME NASDAQ volatility product coming down the pike, sir?
Very interesting development. I am going to take a really good look. I know Scotty Nations. He's a fantastic guy. But I will definitely be looking into this volatility product and talking to Tim myself. So I'm looking forward to him being on the show, one, and two, it's really interesting. Really interesting. And again, NASDAQ is, a tremendous benchmark that has a lot of investments benchmarked to it, and some tremendous volume and open interest on CME Group. So interesting times ahead of us.
Interesting times indeed. So look forward to those upcoming episodes of TWIFO. We'll get into that in a little bit more detail. But now we get to keep this train rolling. John, I know you've been paying a lot of attention to the rate space and the treasury space, in particular through the lens of volatility. So what's been catching your eye? What's been lighting up your tape over there in the Treasury vol landscape of late, John?
So our trade over the better part of the last 2 months, really since the beginning part of June, has been relatively quiet. We've had pretty tight ranges and whatever else, but last week the market received some pretty decent economic data. Both the ISM and non-manufacturing ISM numbers came in stronger than expected, and of course the employment numbers came in stronger than expected as well. So the Treasury market has kind of seen a little bit of a repricing. And normally what has happened over the course of the last years, as you know, has been sort of this concept of even when employment numbers came in a little bit on the stronger side, Treasuries would maybe kind of give it up for a day, and then kind of spend the following week, i.e. the second week of every month, which tends to be pretty quiet from an economic announcement perspective, kind of grinding those losses back and just kind of sort of buying the dip and maintaining yields in a low range. Earlier this week, we've seen a little bit of a kind of a reversal of that. We had the strong economic data set of last week. The corporate calendar got very heavy the first part of this week. Apple had another sizable issuance here this morning. And also, too, both CPI and PPI are coming in stronger than analyst expectations. And so really expectations from the street and from street economists and strategists have kind of proven to be a little bit too dour. And the Treasury market has reacted correspondingly with a steepening trade and with a move towards higher yields. Now, up until a sloppy 30-year auction about an hour and a half, maybe 2 hours ago, what we were seeing in the sell-off, we were seeing volatility get sold. However, about 2 hours ago, we had a rather sloppy 30-year bond auction. Treasury auctioned off $22 billion in 30-year bonds. The auction came about 2.5 basis points higher than where the market was at noon Central Standard Time. And so we've seen a re-steepening of the Treasury curve here and a follow-through now to the downside in prices, rise in yields, as again, the market is kind of, concerned with, well, not concerned. I think is readjusting to economic data. The economic data set out of July was stronger than expectations. But really the market's also reacting, Mark, to this whole concept of increased Treasury supply. And it's kind of tough to when you have inflation running at 1.3% year over year. Let's say the headline CPI number. I think it's really difficult to find true value in a 30-year bond that yields 1.43%. For the next 30 years. And so I think there's a little bit of a repricing taking place. But up until about 2 hours ago, the story was the move to higher yields was being met by sellers of volatility, i.e. the market wasn't thinking that we could see a significant move higher to higher yields. But since the sloppy 30-year note auction about 2 hours ago, we sort of resumed this move to a steeper Treasury curve. Good for banks, good for stocks, good for bank stocks, mind you, but also to kind of the steeper curve and very sloppy price action on the very back end of the curve as we've had sort of trouble absorbing some of this supply at very low yield levels.
Well, let's price it up here for ourselves. You're talking 30 years. Maybe we'll start there, John. You guys, of course, cmegroup.com/TWIFO, then go to the drop down out to rates. Click on the 30-year, and you could follow along with us. Coming into showtime, we're seeing this 30-year front future at about a 177.25. That puts it down a little over 2% on the week so far, so alluding to maybe some of the fallout from that auction that John was just talking about. Coming in here to showtime, we're seeing the SEP contract that has a whopping 8 days to go. That did the lion's share of the paper this week, 59.3%. So pretty much all the paper out there in SEP, and decent paper this week in the 30-year as well, about 686,000 contracts. That's over 200,000 contracts more than last week. So maybe that auction driving a little bit more paper out here this week. The vol, though, let's see, vol actually, again, it's kind of hard to talk vol with 8 days to go, but that's kind of where we have to hang our hats, listeners. Pretty much all of the paper was in this 1 month here, and it has 8 days to go. The vol kind of slightly unched up slightly on the week to about 8.5, almost 8.6 out there. Not a huge vol movement given everything else we're seeing out there. The skew last week, the puts were nearly 5% rich to the at-the-money. From a vol perspective, they were about 4.7% rich this week. About half of that, they're about 2.6% rich. So coming in a little bit on the put side, the calls 1.8% cheap this week, 2.6%. So the puts coming in and the calls coming in. Vol staying kind of steady, so both of the wings kind of coming in. Maybe that's reflecting, obviously, we're post-auction, so a little bit of the expectation for a grand movement coming in a little bit out there this week. And the big print out here, let's see, this week was the 178 even puts, so roughly 3/4 of a handle in the money puts are the big dog out here, doing 40,687 contracts. The big day was Tuesday, about 12,500, followed by about 11,200 on Wednesday, 10,700 today. Slightly biased towards the opening net on the week, so most of that coming on Tuesday. So a lot of back and forth on this strike because it was close to at the money, kind of makes sense. And maybe we'll see if today's paper was closing or not. Followed hot on its heels by, looks like 177 puts. So that makes sense. 178, 177, the two kind of big strikes right around 177.25. Leading the paper this week, did about 32,000 contracts. The big day is today, 18,000. So over half of that going up today. The rest about 9,000 on Tuesday, 3,800 on Wednesday. Not much going up on Monday out there. And that's at least the paper going into today was biased towards closing. So interesting. We'll see what today's paper, what that brings to the equation out here. John, you were looking at the 30-year. Does any of this data surprise you? And are there any other areas of Treasury volatility you want to analyze here on the show before we roll off into another complex, sir?
Well, Mark, I think that there's kind of a phenomenon going on globally. I think some of the move from longer end treasuries is also being driven by overseas. The Buxel, that 30-year bond contract over in Germany, has finally returned to positive yield space, and so sort of this whole idea that there's the potential that policymakers could have possibly overdone it in their reaction to the COVID shock that took place in March and April, and Buxel yields kind of finally moving back into to positive territory. I think it's also sending kind of an important a global message, or an important message to global investors that here in the short term, yields just may have really kind of overshot to the downside. And again, if we do get a vaccine, if there's a major announcement, regarding a vaccine, of which there is plenty incentive for that to happen, especially ahead of, let's say, like November 3rd elections, that could be a little bit of a short-term game changer as well for bonds. And so there is a little bit of a drive to shorten duration by institutional managers and significant pools of capital here. And again, we would suggest that perhaps far out of the money puts are probably a little bit relatively cheap, and I think you've hit on that as well. I'll say to you again, kind of a simple thing for investors to keep an eye on is the MOVE Index. And the MOVE Index, as you know, earlier in the month, actually at the very end of July, hit an all-time low of 40.66. Now, yesterday it went off at 44.2. And earlier today, again, before this sloppy 30-year bond auction, it was softer on the day, but it's kind of moved. It's moved a little bit higher net on the day. And we would suggest that, kind of given where the MOVE Index is, that the 5 and 10 delta stuff on the payer skew, on the put skew, is probably not a bad way to be long volatility, asset volatility, whether in regard to the dollar, equity markets, or whatever else. But the 10 delta stuff probably offers a little bit of value if you're looking for, if you're looking to kind of hedge out any sort of view between now and, let's say, November or the November 3 elections.
The good old MOVE Index. Not what we talk about here on the show. We usually talk about a lot of equity volatility, but in the rates complex, the MOVE Index is kind of like the VIX of all things Treasury vol out there. And that's at about a 44.25 right now, listeners. Puts it off about 2.3%. I know percent to percent. People hate that in the vol space. But c'est la vie. That's just kind of the convention we've all adopted out there. So interesting stuff. Maybe some out-of-the-money puts are intriguing, as John was alluding to out there. You were also alluding to earlier, John, so much what we're seeing right now is a dollar-driven trade. It's hard to argue that our next category here isn't certainly being driven by what's going on in the dollar. This is, of course, all things precious, a.k.a. gold and silver in particular. Gold and silver also dominating our movers and shakers reports this week, listeners. Gold number 3 to the dark side, off 5.33%. Silver number 2 to the dark side, off almost 5.5% this week. So taking a little bit back after having rallied so hard this over the last couple of weeks out here. Gold at about 1952, so shy of that 2,000 level everyone was watching for a while out there. Speaking of watching, folks have certainly been watching what's going on from an overall precious metals volume perspective. See me putting out a release pretty much right before the show here saying that the metals market has been exploding, as you might assume, over the last couple of weeks. They hit a record volume of 1.55 million contracts on August 11th. That blew past the previous record of 1.51 million set back in February of this year, February 28th to be precise. I want to break that down a little bit. It was 397,000 silver futures traded on August 11th. That's a new record. That beat the previous record of 329,000 set just a few days earlier on August 7th. So silver is more of a later story than February. It's more of an August story, whereas precious metals or gold, I should say, are really setting records back in February as well. Also the second highest metals volume day on record at CME overall. 1.66 million contracts traded here. Interesting. So that's overall precious metals markets. I guess overall, if you add in all of the metals, so the non-precious as well, is the second highest metals total volume day. So it's the highest precious metals volume day, not the highest overall metals day. Also worth noting these micro contracts. Everyone's liking all things micro in the equities. Micros in the gold also hitting some numbers as well. CME micro gold hit a record of 303,000 contracts on August 11th. That beat the previous record of 264,000 contracts. That was on July 28th. E-mini silver also hitting a record 3,700 contracts. Beat the previous record set back in 2011. So some interesting records on tap here for the metals over the past couple of weeks, given with the price action we've seen out there of late. Probably not surprising. Let's break down some of that price action and some options action right now. Let's start in silver out here because it was the bigger mover and shaker out here this week. I should say gold. As gold was the second or third biggest mover and shaker to the dark side this week. So let's get out there. It's also the one a lot of you have been fixating on of late. 19.5, 1952 right now. Actually, that puts it off 66 handles or about 3.25% on the week. The big month out here was September with about 28% of the paper. Looking out to September, it has about 13 days left to go. So that's slightly within our 2-week window we like to use to analyze skew, listeners. But I guess we'll break our own rules. It's close enough to see what's going on out there. Let's see. The vol ticking up a little bit, 22.75 or so. Puts it up about a quarter from last show. So up ever so slightly out there. The skew, let's see. The puts were 1% cheap last week. This week, even cheaper, 3.1% cheap. So the puts coming, getting hit a little bit. And then the calls were 4% rich last week. This week, the calls 6% bid. So calls getting bid, puts coming in a little bit. Maybe it makes some sense as we're moving down the skew curve a little bit. Let's see really quickly what was the big trade out here. By the way, about 295,000 contracts on the tape in gold this week. That's up about 60,000 contracts from last week. So pretty impressive numbers again this week. It was the 2,000 even call. Go figure. When we hover around these round numbers, that tends to aggregate a lot of the liquidity. That's pretty much what we saw again this week. The 2,000 even call in September leading the tape with about 7,700 contracts. The big day out here was actually Wednesday, 3,700. So about half of that paper going up on Wednesday. Today, about 2,200, 1,600 on Tuesday, only 182 on Monday. So the last couple of sessions been the big ones here for the 2,000 calls as we're breaking through it to the dark side there. Also seeing some action on the 1,900 puts. They're hot on its heels with about 7,500. The big day was Tuesday for those, 3,400 out there. 1,900 yesterday, 1,800 today. So 2,000 strike and 1,900 strike, both firmly in the crosshairs this week. Not surprising when we're hovering right between the two of them at about 1,952 or so right now. John, I'm sure metals has been lighting up your tape over there in RJO over the past few weeks to month as well. What have your RJO customers been up to out there, and what have you been noticing out here in the metals market over the last month or so, John?
Well, Mark, look, the metals market is a synthetic dollar trade, right? And so as the dollar has weakened, the metals markets have really shown some life. And here's the thesis. And I think this is going to be a thesis within markets for the next weeks, months, and even years. And that is this. Coming out of this COVID, the COVID episode, the U.S. government is going to issue trillions of dollars, and that's with a T, trillions of dollars worth of bonds in the coming years to finance their rescue packages for the economy. And what will happen is that Treasury will issue those bonds, and the Federal Reserve will buy many of those bonds in operations that are kind of euphemistically referred to as quantitative easing. But the Treasury will issue, and the Fed will buy, and the Fed will put those treasuries into their account at the Federal Reserve Bank. When the Fed buys those treasuries that Treasury issues, they put U.S. dollars into the system. They buy them from banks, they buy them from brokers, and eventually those U.S. dollars get into the international monetary system. Well, look, the fact of the matter is the supply of U.S. dollars is going to increase dramatically in the coming years. And with the supply of U.S. dollars ratcheting up exponentially within the global financial system, you're going to see the odds of inflation starting to perk on up. There's just going to be a lot of dollars chasing too few goods. And the sort of the game there too is for the United States. The position of the United States government to hold the world's reserve currency will be challenged. I don't think it'll topple, given our respect for law and everything else in this country, and accounting laws as regards investments and stocks and real estate and all that kind of stuff. But I do think that you'll see a tremendous supply of U.S. dollars in the global markets in the coming years, given this avalanche of supply coming from Treasury. And what gold and silver markets are telling us is that as the supply of dollars goes up, the value of dollars will go down. And if the value of a fiat currency is going to go down, you're going to want to own hard currency. And the two best ones around are gold and silver.
There you go. Put it very succinctly out there, John. But you're right. It is fascinating how much of what we're analyzing today is really, as you put it, a synthetic dollar trade. And it certainly is never more apparent than out here in the metals. Speaking of the metals, Sean, you guys over at FTSE, you hang your hat on a lot of small caps, but the FTSE folks analyze a bunch of stuff over there, FTSERussell.com. Check out the blogs, listeners, in between shows. You can see what I'm talking about, including an interesting piece called Why All That Glitters is Gold, breaking down a lot of the hot action we've seen out there, talking about gold rocketing past its 200-day moving average, nearly 2,000 a troy ounce, breaking the previous all-time high that was back in September of 2011, even breaking and blowing past the gains we've seen in some of the high-flying tech stocks out there this year. So some interesting analysis out there, the impact of inflation going on out there, maybe some of the expectations for inflation, how that plays back into gold and the yield curve out here. Also, interesting analysis, this comes from Bloomberg here, about looking at what we talk about here in the show a lot, what the volatility and the skew are pricing in from an expected move out there in gold. The Bloomberg's folks crunching the numbers out here. I think this was this week, looking at the probability distribution from the options, how that prices in what the expectations are for the underlying, as they term it, the probability of making a new 52-week high out there in gold, 39%, according to the skew, versus a new 52-week low, only 2%. So interesting viewpoint out here. We kind of saw that reflected in some of the skew numbers. Interesting stuff. Sean, you talked to a lot of the metals guys over there at FTSE Russell. I got to imagine, you focus so much on the micro over there in terms of small cap stocks, but there's so much, as John was saying, so much of this trade we're seeing, not just in the metals, but in the equities and everything else, is dollar driven. Is this some of the research you've been paying attention to, or maybe some of your clients over there and the end users at FTSE Russell paying attention to all this research over there these days, Sean?
Absolutely, and John nailed it on the head. And I do have to say, boy, I'd love to have John on the show more often, because I just love listening to him talk about the markets and the economy. He just does a fantastic job, and RJ O'Brien is one of those fantastic firms. So I'm glad you're on the show to say that. But you're absolutely right. There's so many correlations as we have a weak dollar. People look for strength, and people look for security. People look for of places where their assets can maintain or continue to grow. And as the dollar weakens, the precious metals become a safe place to go, and it always has. It's historical, but it's just really interesting to see as the dollar moves and the reaction in bringing it back to the equity market as well. The equity market is that engine that continues, and it truly continues. People are looking for price appreciation, and it's really interesting just to see how this economy is voting during these times with COVID, et cetera. So I like agreeing with John across the board on many of his comments today. Sean,
thank you. I very much appreciate your nice words, and of course, it's a pleasure and honor to be here with both you and Mark. I'd like to plug in one other thing that I think your listeners and your wide audience would like to hear, and that is this. For institutions, whether they be real money accounts, central banks, or even levered accounts in large hedge funds, the thing that they look for, too, in expressing this short dollar trade or this long metals trade is they don't want risk concentration within their portfolios. And one of the coming ways on a secular basis that these large pools of capital will use to sort of mitigate risk concentration is by going to another form of fiat currency. So you've got the dollar. We talked about hard currencies, but the up-and-comer and the one to really watch, I think, is probably Bitcoin, because that diversifies risk as far as money managers are concerned if they're looking to express a short dollar or even neutral dollar view. So CME Group, I think, has been sort of on the cutting edge of sort of seeing this and developing a futures contract with Bitcoin, right, and having a Bitcoin futures contract, because that is in many ways a risk mitigation, risk concentration, diversification tool that I think in time will do very well as well within this short dollar trade.
Well, John, we have a little bit of time before we have to get some of our listeners on the show. So we have time for one more complex. We touched on metals. We touched on equities. We touched on rates. Where else should we hang our hat here on this movable feast that is TWIFO this week before we dive into listener mail? Pick a product, John.
Boy, I'll tell you what, Mark, that's challenging. That's difficult. I think that if you sort of have to look at sort of the universe of things, I think you sort of want to keep an eye on crude oil. It's sort of, look, I mean, we obviously had a historical low earlier this year, right? And we saw things that, conceptually we never really kind of thought could take place. Crude has stabilized a little bit, but there's still a lot of economic damage that has followed the plunge in crude prices, and specifically as relates to the United States' ability to drill profitably oil and the fallout from the fracking industry. So my point would be this. My point is that, with a lot of discussion about the dollar, valuations of stocks, valuations of stocks gets a little bit tricky, right? In a zero interest rate environment, all you're doing is present valuing back future earning streams at a discount rate of zero. So, stocks could probably go a little bit higher here, given kind of what the liquidity that's being provided by the Federal Reserve and the outlook for earnings. We don't even quite know what earnings are going to be exactly, but if they're discounted back at a rate of zero, that's the present value, and that future value is the present value. So, but I think crude oil is probably something to watch because so much capacity has been removed from the crude oil market, and thus my point would be, and again, I think this is more of a note on the margins for your listeners and for investors, is that with so much capacity having been removed, specifically domestically here in the U.S., should we get an announcement of a vaccine, and should perhaps the global economy outperform analysts' expectations and survey numbers, crude's probably got a little bit of upside. And when crude has upside, as you know, that feeds into the short dollar story. So I think also too, I think for investors and for the sophisticated learners, the sophisticated listeners that you have for your show, Mark, I think keeping an eye on the call skew in deferred crude oil futures contracts makes a little bit of sense.
How did I know you're going to mention crude oil? I happen to just have pulled it up here on my screen, just on the off chance you were going to go in that direction, and it looks like it worked out here. Of course, WTI coming at showtime, as John mentioned. Back up north, it's just north of that 40 handle. I think we have a listener question about that a little bit later, so I'll defer my analysis of that for now. Up about a little over a handle, about 1.09 handles, or about 2 2/3% on the week. Most of the paper, nearly 40%, going up in this SEP contract that has 4 days to go. So it's kind of hard to analyze. The vol, we'll look at it really quickly. The vol has come off markedly in that contract, 2.5 points over the course of this week, down to about 11.5. Of course, it's mostly gamma with 4 days to go, but that's a conversation for another day. Let's jump out to another contract that has a little bit more time to go and also had some decent paper this week. Let's go out here, listeners, to October. That did about 18% of the paper. That has about 35 days to go. The vol out there is also off, but a little bit less, off about 2/3%, so about 1390 or so here for the vol in October. The puts, let's see, the skew, 7.6% rich to the puts last week. This week, 12.8%. So if you're wondering if folks are going to continue to fade this upside, certainly seems like the skew is showing that in October. The calls were 4% cheap last week. This week, they're 8.5%. So selling calls and buying puts. It's yet another week of the same old story out here in crude. It hasn't worked out this past week, but longer term, it seems like folks not exactly buying this rally. The big print out here this week was the 45 strike. That's interesting. 45 calls in September were the big one with 9,275. Most of that closing. So it looks like as maybe we threatened. The big print was on Tuesday, 5,600 on Tuesday, 2,000 today, about 1,000 yesterday. Most of that closing on Tuesday. So maybe as we started to threaten that strike, we didn't really get that close to it, but still, I guess breaking through 42 up to 42.5 was enough to get people spooked, and they took off maybe their short calls to that way. Either way, closing a decent chunk of calls on the 45 strike this week, which is kind of interesting. Not exactly what I expected. Number two were the 41 puts. I might make a little bit more sense. 7,300 of those, the lion's share going up yesterday, about almost 3,000 on the tape yesterday. Let's go out a little bit more, see what else was printing out here. We talked about October here with a lot of the paper, 18%. The big print out there was the 45 calls as well. 6,200 of those bad boys. And given what we saw in the skew in October, I have to imagine they were fading that. Lion's share, actually, that going up today. 3,000 at 6,200 in October went up today. 3,100, actually. So almost exactly half. And of the other paper that went up this week, it was mostly opening. So it looks like opening fading here. So maybe they were taking off some of the 45s that are going out in a couple of days, rolling it to October. Either way, folks are fading this upside here in October on the 45 strike here this week. Let's go out a little bit farther, see if we see any other just weird prints. Out to Jan, the 52 calls were pretty active. 5,001 of those trading. 2,500 yesterday, and that was all opening, and another 2,500 today. So either they took them off today or they traded the exact same amount. 5,001 total trading on the last 2 days, which is kind of interesting. 52 calls. Doesn't seem like anything else went up with it. 50 calls 500 times. That'd be a weird ratio, 1 by 5. So it seems like 52 calls in Jan, also active. So maybe some folks, let's look at the skew really quickly and see how the skew changed in Jan. The calls were 2.9% cheap last week. This week, 7.2. So it seems like maybe that's a bit more of an upside fade here as well in Jan. So it seems like no matter where you're looking here this week, the story is the same in crude oil, listeners, and WTI. Buying puts, selling calls, fading the heck out of this rally as we continue to move north here and as we continue with the show right on into your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to your segment, the Futures Options Feedback segment. Let's kick it off here. See how many of you we can squeeze in our time remaining. Damien, this is what I was just alluding to earlier, his question. Are you surprised by WTI remaining above the 40 strike despite what the option skew was signaling? Yeah, I am a little bit surprised, Damien. I mean, I guess it's not exactly overall long-term surprising because they have been fading it every week. So I guess in the last week or two that paper fading it wasn't surprising to me, but the fact that WTI could kind of resist that and remain stubbornly north of the 40 strike, 42 1/3 or so right now, despite the fact that it looks like every month we looked at, people are fading it, that is a little bit surprising to me. Usually the options skew out there is a pretty good harbinger for what we expect to see out there going forward, and yet for the last couple of weeks, even though the skew has been fading it, the options have been fading it pretty aggressively, WTI has remained stubborn. It flirted with it a few times, breaking the 40 handle, never really quite got there, and just fleeting and then right back up. So, yeah, that is a little bit surprising to me. John, is it surprising to you that WTI has managed to claw and fight its way and maintain its level above 40, maybe despite the fact of some of the other signaling we're seeing out there, sir?
Yeah, no, absolutely. If anything, Mark, we tend to look for ways to maybe trade counter trend, or maybe kind of look to kind of see which way positioning is, or sentiment is leaning. And by the data that you've raised as regards crude oil, it tells us that the market's kind of leaning more towards a little bit of a bearish outcome for crude. The fact that it's been able to hold the $40 level, psychologically important level, is kind of impressive. But the options market is telling us, the activity more on the puts is telling us that sentiment is leaning towards the downside. And look, we see that as an opportunity. I think, for those who, sort of want to maybe participate in a gamma trade, maybe kind of, some sort of short-term pop or whatever else in crude, and maybe a short-term pop in crude coming with, maybe like an announcement on a vaccine, let's say for COVID, for example, and the market pricing that in. Look, rich put skew versus cheap call skew, offers us opportunities. And that's sort of how we look at it. But to answer your question to the point, yeah, are we pleased and satisfied with the fact that crude's been able to hold that psychologically important $40 level? Without question.
Certainly is a psychologically important level out there, and for the time being, at least, that is interesting. Damien, it sounds like you're surprised as well. Maybe if that's the case, if you guys are bearish, maybe it's expensive to buy those puts right now. But if you are bullish, they're fading these calls. Maybe that makes an opportunity for you to get a cheap upside position on here in WTI. Certainly cheaper than if the preponderance of the market out there was buying what this market is selling and really betting on crude running off to 50 and beyond in the near future. Let's see, next up, John, this one's right up your alley here. This comes from Spicer59. He or she asking, why are futures options still considered second-class citizens at most brokers? If I want to trade Apple or SPY options, they roll out the red carpet, but it seems like they don't offer the same bells and whistles for crude oil and treasury options traders. Why is that? It's an interesting question here, Spicer59. If your question came like 4 or 5 years ago, I would agree with you more than perhaps I do now. I think the overwhelming trend throughout most of the brokerage space has been to try to grow the darts, grow the assets that they have and the amount of trades that they have their clients doing. And particularly in years back in, let's say, 2017, when equity volatility wasn't exactly lighting things up, they had to expand into other areas. So a lot of brokers going out there and really pushing new asset classes like crude and others, making acquisitions to expand their offerings on that front. And they also have done a lot of work behind the scenes to kind of hide a lot of the layers of obfuscation and the hurdles. They used to have to open separate accounts, log into a separate account to trade the futures, log into another account to trade the equity options. Most of that has been done away with on most of your major platforms. It's a much more seamless experience. You could effectively be trading 2 different accounts, but you never would know it from the front end. It makes it all look like one UI. They keep the balances aggregated. It makes it a lot easier from a client access perspective. So I think it used to be the case, but maybe not as much anymore. But John, I'd be curious to get your thoughts on this because you live in that world. Obviously, RJO, a little bit of a specialized case. Your raison d'etre is futures and futures options. But what would you have to say here for Spicer59 and his allegation that most brokers view the futures and futures option space and the clients that trade it as second-class citizens, sir?
Well, there are 2 things. First, if you're an investor or a trader and you want to use a brokerage shop that does not trade futures and options or treat futures and options as a second-class citizen, obviously R.J. O'Brien would probably be the first and only call you'd ever have to make. More specifically, Mark, I think a lot of that has to do with the way that the futures and options markets have been portrayed by media and by Hollywood specifically. You kind of go back to movies like Trading Places and things like that, and sort of the sense by the average, I think, American is that, the futures and options guys are a bunch of swashbucklers. But really kind of what's happened in the last 20, 25 years, 30 years even, is that futures futures markets have become much more sophisticated. We're much deeper and much more liquid than we used to be in the 70s and early 80s. Sophisticated users, sophisticated managers of large pools of capital have come in here to mitigate risk and to hedge out risk, and also too, regulations become much tighter and much more stringent. So, and which is healthy. So the market has a much more robust foundation than it did back in the days when Hollywood used to portray futures and options markets as being just kind of the wild, wild west that was unregulated or whatever else. So that's my sense. My sense is that for more sophisticated investors, whether they be retail or institutional, the futures and options markets are much different today than they were, let's say, 30 or 40 years ago. And I think that brokers specifically there's been a sort of a historical tradition in treating the futures and options markets like that. And look, I mean, some of your over-the-counter products, to be frank, have a little bit more margin in them. If you're an institution, if you're a Procter & Gamble, and you're going to go to Goldman Sachs to do an interest rate swap, well, look, the transparency of pricing within that instrument isn't as clear or as vibrant as transparency of a 10-year Treasury note future. And thus, the price paid by Procter & Gamble is going to be a little bit different than the price paid in a 10-year Treasury future. And so I think that in time, that is all changing, at least from the eyes of sophisticated risk managers. And so I would expect that to continue to change. But there is a historical precedent by large brokerage firms and banks to maybe kind of market their own products first to their clients before they market futures and options product.
Well said. Unfortunately, that music means we've come to the end of this epic journey through the world of futures and options. But Sean, I'm curious, if you have something you want to add to Spicer 59's question, because you're out there working not just with the institutionals, but also a lot of retail to try to get them to adopt futures options. I'd be curious what your thoughts are on the general landscape of the futures options broker space. If you have any thoughts there, have at it, Sean. And then B, if folks are intrigued, they want to check out some of this research we were talking about earlier or anything else you got cooking over there in FTSE Russell land, where should they go? What should they do, Mr. Sean?
Thanks for letting me make a quick comment. Yeah, historically, John's nailing it on the head. But, the other thing that listeners should think about is the product specs themselves and the size, the notional value of a futures contract and the notional value of an option on a future. Historically, they've been pretty big contracts. And, our partner exchange, CME Group, has just done a phenomenal job reducing the notional value of the size in launching the micro futures and the micro options now on NASDAQ 100 and S&P. And we're hopefully going to hear some more equity products coming in the future from CME Group. But again, these micros have just done a phenomenal job. And I think they answer the question for those that are uncomfortable trading a large and notional value contract, because it's the most successful product in CME's launch are these micros. So I just think that there's a client base who's now been heard by CME Group, and these products have answered and created a solution for them so that they can enter this market and in the size that they want to enter it. And you've got institutional money trading these as well so that they can surgically enhance their portfolios. And you can reach me at smith@FTSERussell.com. Happy to answer any of your questions personally, and go to the FTSERussell.com website for really interesting information about COVID. We have lots of detail there for you to take a look at why markets are acting the way they react to various things within the marketplace. So thanks again for having me on the show, and John, it's always a pleasure to be on the show with you.
Well said, sir. Folks, if you're intrigued, interested in all this kind of data in between episodes of this show, FTSERussell.com is the place to go. They have all the, not just the data and the links Sean was talking to about earlier about some of these articles with the Russell 2000, but with the gold and all the other things, the COVID, the impact of the market from COVID. That's a huge database of articles, and it's just growing day in, day out. So if you're listening to this show outside of our broadcast day and you want something else to sink your teeth into, FTSERussell.com is the place to go. Give them a follow on the old Twitters as well, at FTSE Russell is the place to go. And John, if folks are intrigued, maybe let's leave them wanting more. If you want to drop any hints or teases of what they can expect from you guys at RJO in the coming months, now is the time, sir. The floor is yours.
Well, thank you. I'll say that's a broad mandate, Mark, that you're asking me to fulfill. But look, we're coming upon some dynamic times. Obviously there's event risk with the COVID thing that we've discussed, development of the vaccine. We have important elections coming down the pipeline, especially with this whole concept of mail-in voting. And so, one of the things that we've been talking to our investors about, and I'll leave you with this, is that we think the odds of the finality and a clear-cut decision regarding the elections is probably going to carry on well beyond the November 3 date. We think that the vote counting is going to be a very hard-fought, tight election, and we think that investors might want to consider, maybe kind of shorting volatility in the equity index. This is how we would do it. We look at calendar spreads against major stock indices with the idea that November E-mini options that expire the third Friday of November may not cover the election results, but December options may. So investors may want to look at kind of calendar spreads, kind of depending on their views of markets and candidates and all that kind of stuff. But we may not have a verdict by the third Friday of November. We should have a result of the election by the third Friday of December. And so I'm going to leave you with that kind of concept, that idea, and that is, maybe calendar spreads in risk asset calendars with the idea that the election won't be decided on Tuesday, November 3rd or on Wednesday, November 4th.
Yeah, certainly if you believe the volatility surface out there, they're pricing in some vol well beyond the election out there. And John, if folks want to kick the tires and light the fires over there at RJO, where should they go? What should they do, sir?
Oh, well, give us a call here at RJ O'Brien. You can send me an email at jbrady@rjobrien.com, and we'll certainly help you with any questions you have. And if not, we can certainly point you to one of our kind of many professionals and superstars here at the firm to help guide you or advise you.
There they are. Check them out, RJ O'Brien. If you're trading these products, you probably already know about them or have an account, but if not, head on over there, kick the tires, and light the fires. And, of course, you know where to go for all the great reports we talk about on the show all the time. CMEGroup.com/TWIFO. While you're there, of course, check out all the great research from Blue and from Eric and everything else they have cooking over there, the FedWatch tool. You can get lost for hours in the various tools and research and data over there. So beware. Once you head over there, you're going to spend some time, but you'll probably enjoy it. And on behalf of Sean and John and our friends over there at CME and myself, I thank all of you out there for downloading, streaming, subscribing, for listening live, for sending in your questions. Remember, if you like what you hear, keep those reviews coming in your platform of choice. It helps new people continue to discover the program in these troubled times. We'll see you back here on the network tomorrow, 1 p.m. Central for Volatility Views. And we're back again next week on Monday for the option block all the way through to Thursday for more of This Week in Futures Options.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.